This paper is about attention directing analytical review using accounting ratios, a case study. Briefly speaking, this article is about a case study of use directing analytic review procedures to apply to several ratios. In this paper, we will use three different investigation rules, and we will use them to study different material accounting errors of different types. After they do the test, they find the result that it's very important to know the relative size of the accounting error. And they find that the error is material to year-end financial statements may not be relative to natural variation in 3 or 4 monthly ratio tested, which is row 1 method, the traditional method. And they find that what we need is that we need to find the disaggregated base data, and we need to care in defining unexpected relationships. And I think that there may be potential to find the usefulness of considering of deviations in several ratios. In this paper, they try to define the type of error by compare pattern of observed changes in several ratios to changes that would be expected given a particular type of error. The introduction part, we talked first about the background of this kind of study, as many articles already presented today. It's like analysis of ratios of account balance is widely applied to attention directing procedures. However, little is known of the ability of ratio analysis to identify the material monetary error in actual accounting data. So it's desirable that we can conduct such analysis over many firms as well as several time periods. First, we want to obtain the reasonable disaggregated data. We think that after we get that, we can do further study. However, we know that in reality, it will be very difficult to obtain that. Therefore, in this paper, it's only used a single firm for over 4 auditor years. First, we want to talk a little about how this paper measures as materiality. Here is the formula. We can see that. I want to explain that the 1.08 is the expected sales growth rate. I will explain more details in the next slide. We want to seeding a material amount for a single error test. We think it may seem excessive, but it seems unreasonable to expect attention directing analytical techniques to correctly identify very small errors. This analysis will illustrate a best case for detecting an error just large enough to be material. Here is how we calculate this expectation. In this paper, the monthly ratio for the sample firm is compared with the data from its own past, adjust for the median change for the firm's industry. In this paper, a reasonable expectation for the value for a ratio in months T is assumed to be the average audited value of the same ratio for the previous audited year, adjusted for changes in the industry. Okay, now we go to the most important part, which is the ratio. We know that here in this paper, we select account balance related to the basic purchasing and sales circle of the selling firms that are used. We want to make sure that the ratios are selected on the basis the ability of a ratio to reflect the changes due to error types. Of course, there are other ratios. However, we see that other ratios, they combine several accounts. So there will be of little use when we want to use them to indicate the error in a particular account. So here are the four ratios we will use. They are receivable turnover, inventory turnover, cost of sales ratio, and accruals ratio. We know that the first two ratios relate an income statement account to a balance sheet account, and the third ratio relate to income state account. The last one, it relates one balance sheet account to another. I think it can reflect at least four types of event measures the liquidity. Here is the result when we try to check the standard deviation and mean. We can see that there is a relatively little natural variations in the cost of sales ratios. There is little. And there is a relatively large variation in inventory turnover here. I think this follows from the fact that the amount considered material is often quite small relative to a particular account balance, especially for annual balances. Thus, the analysis of annual change cannot be expected to indicate errors from more than material account amount. In this page, we will explain a little about the error conditions. We know that in the following analysis, we will have two types of errors, which is I mentioned in the abstract part, which we want to test. They are purchased on account but not recorded, and fixtures sales on account record. Here are how they will reflect on the ratios. For example, we can see that if there is an omitted credit purchase, there will be a decrease in the inventory turnover, decrease cost of sales, and increase accruals. If there are fixtures credit sales entered, there will be increase in the receivable turnovers and a decrease in cost of sales and an increase in accruals. When we try to design how we will use the investigate rules, we always have a dilemma, which is the simplicity versus accuracy. So in this paper, they will compare three different rules. The first one is the percentage change rules, which is very simple, and a variation of it has been applied by auditors for many years. The second one is the statistical rules, which requires the calculation of the standard deviation of the prior year's value. And the last one is pattern analysis, which uses the pattern of fluctuations identified by row 2 to indicate which error, if either, seems likely. The first one is very simple. We can see that the RT here is the value we get, and the R with a cap here is the expected value, which is adjusted by the industry like that. And we think that if we should also pay attention to the critical value, because it's very important to for this when we try to do the test. Yes, sorry. Because you all remember that like in different ratios, variation is different. The second one is the statistical rules, which is use standard deviation of the audited monthly value for the previous audited years. And the rule triggers an investigation when the difference between the book value for the test month and the expected audited value is so large in relationship to there is a difference that is unlikely that it's just like coincidence. Here is a formula, easier to understand. And the last one is the pattern analysis, which is accrued pattern analysis for monthly cross-sectional of the first three ratios. And we want to compare the combination of signals to investigate from the three ratios. Here is an example of the third rule. We can see that, for example, if we find that there is no increase in receivable turnover, there's no decrease in inventory turnover, and there is no decrease in the cost of sales ratio, then we assume that there is no alert for either error, and we will have a lot in other situations. Yeah, their summary is that the rule 1 and rule 2, they are ratios. Population ratios is a ratio, and the third rule is like pattern analysis. The basis is the combination of the first three ratios. Yeah, here is like a test result of this study. We can see that first we can pay attention to the cost of sales ratio here. And we can see that the cost of sales ratio doesn't often change by more than 10%. Yeah, because you can see that when the symbol changes, when it's like 0.05, it's like only 5, and when it's 0.1, it's raised up to 39. The ratio other than the cost of sales ratio shows the poor diagnostic power when we use like row 1. Row 2 may be a little better, but when we can find much more uniform cost ratios reflecting the self-scaling features of the row. And the third one, we can also know the number of correct signals, and we can have the ability to investigate what the error type was. When the seeded error is in this part, we want to do a sensitivity analysis of this data, and then we will change the seeded error to 0.5 and 2 to test it, and then we find that when it's 0.5, less than normal, it's increased the type 2 error rate for almost every comparison, and the three ratios are effective in indicating the presence of error. And the second one, the accrual ratio, are ineffective. There is a great decline in correct indications of the seeded error type when there is a 0.5 or 2 times material amount. Of course, all the analysis above is a good method. However, there is risk. So we need to do preliminary explanation analysis. The risk is that the auditor will stop the analytical investigation of an unusual fluctuation before its actual cause has been found. So what we should do is to walk through the account balance implication of the proposed explanation of the deviation, and we should check the deviation of the revised analysis. If we find there are fewer deviation, then we should know that our hypothesis is correct. If it's incorrect, that may adjust accounts that were not in error, or may further adjust accounts where errors already exist. To have a better understanding of this, we can use this as an example. Here is an example that the credit credit purchase of a material amount have been omitted. And we use our experience to find out that lower cost of sales explanations include omitted purchase, overcounting ending inventory, overpricing ending inventory, and cost reduction due to a new economic order quality or a shift in product mix to goods with an unusual high contribution margin. So if we assume that the reduction in the cost of sales ratio is due to the acquisition and sale of a special line of product, what we should do? What we should do is revise the interest that would have been due to the special acquisition and sale. We should also assume that at month and 3/4 of these special sales have been collected, but none of the liability has been paid. So we will subtract them from ending receivables and payables. After that, we can find the variation, and we can compare them to whether this is a real reason or not. Other explanations can be tested in the same way. After we design such analysis, we can know that a preliminary explanation analysis, as discussed above, will not be 100% effective. Of course, some explanations have patterns of control entities that are very similar to those of other explanations. Similarly, for some of the months, the analysts will not show less spread with the correct explanation. However, the revised ratio analysis will guard against accepting some explanations, and it's very inexpensive to apply when a computer assisted system is used. The computer assisted pattern analysis help guard against accepting a causal explanations by carrying out this account and their implications. Okay, finally, we will give a summary of the limitation and future study of this paper. The reliable attention directing and analytical review procedures requires a fairly large ratio of accounting error signal so we can get rid of the natural variation of the noise. And with the pattern of deviation from the expectation over several related issues may be useful in identifying the cause of the error. And the last one is that a preliminary explanation analysis that reverse possible error can be useful in preliminary evaluation of the suggested explanation of the deviation from the expectation. That's all. Thank you.